Hello, this is Steve Schwartz coming to you from Market Traders University and the virtual studios of Market Traders TV. Today is Thursday, July 23rd. We're looking at the crude oil today as we did yesterday. I think it's real important to keep an eye on the crude oil market. It does serve as a barometer. It's certainly an industrial commodity that does serve as a barometer of supply and demand throughout the industrialized nations and global recovery or recession. Certainly, our economies are very weak. We're still in recession, and there's a big question mark looming over the market. Are we in a recovery mode, or are we in a wishing and hoping mode? Well, crude oil today, if we take a look once again at the overall structure, the market had highs made of just above 75, coming down to just under 60. The market bounced back up over the last week and a half, moving to a Fibonacci correction of 38%. That Fibonacci correction comes in just at about 65 and change. It spiked Tuesday and then came back below the Fibonacci level. So right in here is a major high value or resistance level that does come in at a Fibonacci correction of 38% from this high to that low. It's roughly right in this trading range. So the market basically stopped. It rolled over on anticipation of the American Petroleum Institute report. That was Tuesday. It showed a draw of 3.8 million barrels. I shouldn't say draw, an increase in supplies of 3.8 million barrels, excuse me, only to be surprising the market yesterday when the Energy Department released its weekly numbers, which showed a huge disparity and showed an actual decrease of 1.8 million barrels. Let me just repeat that. Tuesday, the American Petroleum Institute showed an increase in supplies of 3.8 million barrels week ending July 17th. In the same week ending, the Department of Energy showed a draw or a decrease in supplies of 1.8 million barrels. Well, that's a big gap, and that certainly is a huge deficit between one report and another, and essentially it has the market completely confused. If we take a closer look at the last couple days, you've seen this wide trading range between 63.80 and 65.70, or roughly $2 a barrel, just in anticipation of both reports. Well, bottom line is, after yesterday's report of showing a decrease in supplies, the market got spooked and has fallen into this narrow trading range between 64 and 65.60. Nonetheless, this is the Fibonacci correction of 38% of that overall decline from the highs to the lows. And it's real important to keep an eye on this, because essentially that if this market is unable, if the crude oil is unable to take out this resistance level, it is going to roll over and probably retest these lows. If you want my opinion, I believe shorting the market right here with really long put options where your risks are completely limited is probably the best guess, with a stop of once the futures get above resistance, you take the put out with a loss. If you want to play a volatility spread, because the market, once again, has fallen into this trading range on the short term, you can bracket the market with a strangle, buying a long call, 67, 68 call, and buying a long put of 63 or 62 put for nothing less than 90 days. Remember, time is an extremely important element in pricing out options. You certainly don't want to run out of time. You can, and if the market stays sideways, you run the risk of losing all of your money. But on the other hand, if you are using sound money management principles, one leg or the other, or the total spread in itself, should be unwound within the first 30 days of the 90-day period, simply because something will happen, and if it doesn't, something's wrong. So you want to exit the position and use good money management principles. Looking at the short term, you can see that the market, now this is a shorter term time frame. It's a 15-minute chart that we're looking at. I've really kind of zoomed in and pretty much tried to show you up close where the resistance is and where the support is. And now something is developing as of this recording, where we're seeing these two candles showing long shadows above the price range with small bodies. Well, whenever these, in candlestick language, whenever the body is less than 60% of the total length of the shadow, it does have a tendency to forecast additional weakness. Once again, I would wait. If we break the 64.80, take out this swing low, You can put on put positions for a move back to these lows for a scalp. I would not wait for or hope that we would break that low. It'd be a great time for a scalping opportunity. If you are a position trader, once again, 90-day trades on options would be advisable, no less than that. And if you are looking to bracket the market, you should look at a couple strikes above the resistance and a couple strikes below the support. Once again, it's Steve Schwartz, Market Traders University. Come to our site, markettradersuniversity.com, and check out Market Traders TV. Thanks very much. Have yourself a great day, and may the best trades be yours.